Welcome to the Payment Strategy Show. I'm Brooke Smith, and I am here today with Peter Michaud from TSG. Peter and I were just talking a couple weeks ago, and he mentioned doing a lot of due diligence to support the valuation of vertical SaaS companies. And I thought this would be a really fun thing to do a deep dive on the podcast. So, Peter, welcome. Thank you so much for joining us today.
Thanks, Brooke. I appreciate the opportunity.
So, tell us about your background. How did you get into payments?
My payment career really started in detail 15 years ago. I was in Phoenix, Arizona, and I started working at TSYS Acquiring in the finance group. I did a lot in the MIS. Then I was the head of FP&A for TSYS Acquiring. Worked on the acquisition of First National Merchant Solutions here in Omaha, and that's subsequently moved to this section of the company and worked in M&A and also market intelligence for a couple of years. And then I moved to a B2B company where I actually ran a commercial card portfolio for about 3.5 years. And then once we sold that, I came over to TSG about 8 years ago. I've been working as, on a lot of different consulting projects. My career goes back 30 years. I started at Arthur Andersen. I am a finance professional, used to have a CPA license. It's inactive at the moment, but that allows me to work on a lot of M&A and a lot of accounting and finance type projects.
Really cool. I know one of the things that you've done a lot as a consultant is look at how embedded payments or integrated payments impacts the valuation of software companies. Mm-hmm. So I would love to dive into that deeper with you today. To kind of level set and provide some context, why is this even a thing? Like, why do investors care about payments?
Investors in companies and software companies really like the payment aspect because it is another source of revenue. So it's nice because you have what we call recurring revenue, which is the software payment revenue, and then you have reoccurring. And this reoccurring is the payments volume, which when you're able to monetize and you're really offering a utility to your clients that they're already paying for, right? They're already going to process payments, and therefore you're just adding that and getting a little bigger share of wallet. So they really like that from a revenue standpoint. Payments can be a very high margin business, and in excess of 80% if when you're really knocking it out of the park. The nice thing also is it's not only just revenue and earnings, but it's also cash flow, because you're getting paid every month on this residual stream that you're going to receive. And that's something a lot of software companies, when they have longer development cycles and they have a lot of resources they need, it's a really nice avenue to not have to go out and get other funding in order to keep the business moving. They also like the fact that it's another product to keep them sticky to the merchant. So there's a lot better retention. And I think it's even better retention if you're just a software company. And there's a certain amount of retention. As a payments company, there's a certain amount of retention. But I think combined, I think you get the benefits of both. So there's really two impacts to the business if they decide to leave. And that's going to add to, much lower attrition.
Yeah, we see that too. When you have a company that's doing like 5 things for you, it's much harder to end that relationship and go find a replacement or 5 replacements.
And software companies are, they're always trying to advance the business. They're trying to make it more efficient and more effective. The payment side is interesting, and I've said this now for years. People say payments is a commodity. My comment is payments is a utility. It's utility you need to use, and every business needs to accept payments. So, and I refer to water, gas, even a cable bill or your Wi-Fi bill, and you go, oh, well, I need my Wi-Fi. Well, what are they charging me for? Well, I'm not really sure, but I just know I need to pay it. So it becomes very much more like utility. And that's why when people have always been fearful, they say, oh, there's price compression. I'm like, not really, because it is a utility and there's a risk base to it. So it's been a very steady revenue stream for years. And I think it also offers some of the benefits from just growth in the economy. And when the economy grows, there's more payments. When there's good inflation, that 2 or 3%. That's a benefit because you're getting paid based off volume. So it's like a rising tide effect. So it's so much different than other lines of business where you're selling a product and it's a price and that's the price you're going to live with, and then you have to go back. You can definitely benefit from when you have customers of the software. When they start getting more prosperous, they're going to take more payments. It's a nice growing revenue stream that's been really outgrowing software.
Absolutely. And I think you're onto something. I really like the utility analogy, because when I think about it, like, I don't really know how much I pay for my cell phone, but I know that I need it. So
exactly.
I don't really care that I don't understand the bill, because canceling it isn't an option.
Right. And changing carriers is very painful. And at least now you can transport the number, but before you couldn't do that, so you had to give everyone a new number. So yeah, but it's the same pain, right? It's the same portion of the business. So is it worth it? Is it worth it for me to leave? So yeah, definitely adds to retention.
Yeah. So when you're asked to do due diligence on a software company and their embedded payments product, how do you approach it? Like, what's your overarching process or framework?
Right. The first thing I like to do is learn more about the business in general, just because it's funny. It's the auditing background, right? Where you want to learn all about the business. What are you doing? Where do you fit? What role do you play? Then I really want to know, do you have the right to win the payment? That's always been a very interesting concept is, okay, I know you have a software and it does this part of the business, but are you interacting with the consumer or the end user who's actually initiating the payment? And if you have that right to win, that's a nice criteria. Assess the business, determine if there's really an opportunity. Then we kind of dig into, where do you fit? What kind of payment programs do you have today? Do you not have one? Is it a referral? Are you an ISO? Are you PayFac? Where do you fit in that whole ecosystem, in the type of arrangement? Then we want to know like who your payment partner is, then we go to the current financials. We want to talk about attachment rate, and then we kind of look at, what kind of flexibility, are you operating within? Are you setting the pricing? Are you doing the customer service? How much are you taking on and how much are you relying on your partner? And lastly, and this is always once you kind of understand that, I always like to talk to the person who's running the payment operations. Sometimes it is someone who is doing it as a part-time to the regular job, and then sometimes it's full-time experienced professionals. So those are always different conversations, right? And that's important because what role does that payments team have? And then what other roles are the company using? Are they sales responsible for selling payments, or is it a separate group? Do you have a dedicated managed service? Are you doing risk and underwriting? It's really interesting because payments is kind of cross-functional across a lot of places. So you really want to learn more about just how it's operating today and what parts of the business these other divisions are handling and how do they incorporate payments.
So can we start at the top of your list and unpack each of these in a little more detail? Because I'm really curious to understand what you look for and how they can then be reflected in the valuation. So like at the very top, when you're just learning about the business, what they do, the type of service they provide, who they serve, how are you thinking about that? Like, how does it impact the rest of your process?
I always start with the history, and I want to know kind of their evolution. Where did they start? How did they start? What stages of the business are they in? How did they get to this point? So history tells me a lot. I always call it an assessment. When we work with clients, I go, I just need an assessment of who are you. It's like a doctor going to a doctor's office and they're going to take a history. That's what I want to do. I want to learn more about you. That a lot of tells me kind of what path you've been on for the last, for the duration and why we're having this conversation today. So that's always the first one, right? Just a basic history. And that tells me a lot. And I ask a lot of questions. And, like I said, based on, my experience and working with a lot of different companies and a lot of different industries, that allows me to kind of take it over to the right to win. And we look at that as how are you interacting with that end user? What function are you giving to your customer to interact with that end user? Is payments a part of it? Are they digital payments? I know that sounds odd, but it still is a question. How much of this is digital or how much of this is check-based? How much of it is cash-based? How much is there a conversion to digital? So you want to know all those aspects of it. And then from the kind of understanding the payment financials and structure, and that's where you get into that really, that's where my audit background really comes forward. And we just start asking a lot of detailed questions. And I can read, I'll read financial statements. We'll read we'll read residual statements. We'll review contracts. We'll assess, how the pricing is, to the merchant, how the pricing is to the customer, how the pricing, what all those aspects are. What is your share of revenue? The contract also looks at, portability, exclusivity, and non-solicitation. Those are always are three big parts of it.
I'm going to pause you there because I have a follow-up question on right to win, and then I also want to jump into the contract terms in more detail. So when you're looking at the right to win, what does really good look like? Like, what is the sort of ideal state that you love to see when you see a software company that absolutely has the right to win payments? There's no reason that their merchants would want to process payments elsewhere.
Sure. I'll bring up a great business case, MindBody, legend in the space, right? So they are really a salon and spa, or used to be a salon and spa, yoga spa. That was kind of their genesis. It was 1 to 2, locations. So they had this great package that an owner could go buy, and they could get appointments, they could get memberships, they could track all their customers in one place. And in the early 2012s, they were approached to, now take payments. Hey, can we do payments as part of this? Instead of running it on the side of your desk, you're running, now through the software. And you could have a hosted payment page. It was gateway based, and it was IP. It was, you could use a peripheral. It was a lot of those little different aspects that made this more feasible than, okay, I have a software to run my business, and I have a payments device on the side of my desk I have to run cards through. Or I have a gateway that I have to put all my card numbers in some other place and run that. When you see that interaction of really the end user, the consumer in this case, to the customer, who is the business that's being run, when you see that interaction and it's direct, right? I'm sending you a bill, you're making that payment, that's when there's that right to win. And that's a very clear case. There are cases where that's not the situation. If you're providing inventory in the restaurant space and you're helping the company manage an inventory base, well, you're not necessarily interacting with the end user, with the payer. Maybe maybe a supplier, but in most cases, those are separate, right? They're not integrated, And I think that's where you have to evaluate where that is. We've also seen in cases where, and I'll date it back a few years ago, because field service was very much a check business, right? And that's where you sent out an invoice and you got paid with a check, and that was it. Or you got a check up front, right, in order to go do roofing or do a major repair, and you took a deposit, And I think now that has all turned into digital. So they never want to see a check. They'd much rather take a card at the point of even pre-ordering the goods and the supplies, because they're willing to take the discount in order to get the cash in right away and not spend a lot of time on collection, and because there always is a cost of collection. So, it's a very much, are we at that state and where do we fit? That's that right to win.
I like that analogy and the contrast between mind body versus, say, inventory management. Because, mind body, the things they're already doing are almost sitting on top of the payment, or like the payment is sitting on top of them. Whereas inventory management, you've got all of these degrees of separation. Is right to win sort of a leading indicator of attach rates, adoption, utilization, volume, and all of the things that we look for later?
I think if you have a good right to win, then that shows you what your addressable market is. So then the conversation is, how much of this can I actually attach to my payments? Maybe another interesting story was, is your software in the cloud or on-prem? That is a great situation where, payments can be more difficult. They might have a separate agreement or arrangement with someone else. So that makes it a little more challenging. But not that but then, but we're going to stop or discontinue that. Well, that's your right to win just got better if you're saying we're not supporting on-prem anymore. And we don't see that in a lot of, but there are a lot of legacy providers. A lot of publicly traded software firms still have a lot of on-prem. And some customers are they like it. They've done it for 10 years. They don't want to learn a new system. They'd much rather keep it on-prem. So that's why you have to evaluate that from the right to win. Last one, I think it's some organizations, you are tied to financial partners. And those financial partners might have some contingencies on, you accepting payments through them. And that is another one. You could have some covenant. It could be a loan, portion of a loan. We've seen this too, where, we've seen this, and it's not as much now, but there still exists, especially if there's commercial financing associated with it. So sometimes you just don't have the right to win.
Yeah. And it sounds like that would be very industry dependent.
Right. Larger entities. And I don't know, typically like a hospital, very vast, a lot of different practices, a lot of different places. How do you take payments? And remember, none of their payments are the same, right?
Right.
They're going to have medical, they're going to have inpatient, they're going to have hospital, they're going to have insurance payments, they're going to have a cafeteria, they're going to have a pharmacy, they're going to have rehab clinic. Hospitals are not just, it's just a hospital. No, that doesn't exist anymore. It's very diverse. So if you have one software that solves pharmacy, well, that's great. But I need something that's good. But I have like 16 lines of businesses within my business. So are you really going to be able to solve what I need? And I think that's where we've seen some of it.
That tracks back to addressable market, because like taking your pharmacy example, they would probably have a strong right to win among independently owned pharmacies, but they would have no right to win for like hospital owned pharmacies.
or the major brands, right? The CVS's and the Walgreens and that, and even grocery stores, right?
Yeah, so that's a much smaller addressable market if they're looking at only the independently owned ones.
Exactly.
And then before we went down the right to win rabbit hole, you mentioned some contract terms that you look for. What are those and why do they matter?
Right. The three we look for is portability, exclusivity, and non-solicitation. So how much do you own of that, the ability to attach to those merchants that you're processing payments for today? I think this really goes into understanding where you are in the payments life cycle and that you are the distribution arm. And if you know enough about the payment industry and how that has been the number one cost in merchant acquiring for the last 30 years, 40 years, is the cost of acquisition. This is why something like an ISO exists, because the banks didn't really know and weren't really excited about hiring a lot of people to go sell merchant acquiring. So this ISO formation came back in the early 2000s, late 90s. And you saw this, prevalence of independent sales organizations. And over the time, they really took over the sales operations for these large processors. And the processor will have a sales arm, absolutely. And then the ISOs started gathering together, and then you have what we call super ISOs, and some of these super ISOs are publicly traded companies now, and they don't actually process the payment from a transactional standpoint, but they actually are really responsible for that distribution and sales. So when we bring up something like a MindBody, which is a great example, or we could use any others that are in the software space, you already have a relationship with the customer. So what's the cost for you to add another thing, another item that the customer needs? How much effort does it take to do that? And I think that's why every payment processor today looks for integrated software vendors. So you already have a relationship. They need payments. Sounds like a great environment for me, right? And now it's just a matter of how do you want to do it? So, portability. Are you maintaining ownership of that relationship? That's the big thing. It's your relationship. You sold the software. That's why they have payments. It's not the reverse. So you're leading with software. You offer payments. Exclusivity. Some folks have signed exclusivity agreements with one processor or one partner. That can always just be tough because what happens if there's changes in ownership? I think we've seen a lot of mergers and consolidations in the space. So the person you sign with is not the company you're working with today. That can always be difficult. Sometimes they might not have the needs or services and support you need to go into maybe a different type of merchant or different type of customer. Maybe they don't offer, card present services. That's significant if you want to try to attach to those merchants. So portability, exclusivity, non-solicitation. Non-solicitation, once again, whose merchants are these? Whose customers are these? And if you pass this over to somebody and you're not able to talk to them about a new product or services, or if you've evolved as a company and you want to take the next step, where do you fit? Are you still maintaining ownership of that relationship?
Yeah. So it sounds like when we look at it sort of through the valuation lens, portability is good because it gives the software platform sort of control over their destiny. Mm-hmm. If they want to switch payment providers, add payment providers, they're free to do that. Mm-hmm. So that gives them a lot more options, and options are good. Whereas exclusivity and non-solicitation make it very hard to change providers. So there's a risk of getting locked in.
Right. And if it all really goes down, if the customer or merchant is having a bad experience with a payment provider, they're going to blame the software company. Every time. So that's why not giving those portions up to the payment processor, once again, they can damage your relationship. And to be honest, you'd much rather, if you're going to do, you're going to be the one responsible for that. And I think that's the key.
Yeah. And so if you're stuck with a payment provider that's creating a bad experience for your merchants, mm-hmm. then that's really hard to come back from.
Right. It's detrimental to your core business. And that's why we see a lot of our clients who work with have gone through those experiences.
Yeah, I have encountered a few software platforms that actually stopped boarding new merchants because they were having such serious issues with their payment providers that it was causing churn on the core product.
Right. And if there's a portability and non-solicitation and no exclusivity, I like to call that free market. Right? It's capitalism at its finest. If you're my vendor and you're not meeting the needs of my client, why shouldn't I be able to go to another vendor and use that? I think that just stems from decades old contracts where the software company didn't know what their options were. They didn't know what the impacts of these decisions would be. And that's why when we get brought into these, we're really there to explain to them, what needs to be in and what needs to be out, what are key terms, that are going to make this a successful program.
Absolutely. I think we're sort of in the where do you fit and what type of payments program do you have category right now. Beyond those 3 contract terms, what else do you look at?
Love to see the structure of how you are today. We kind of break up into five different categories. And there's never a clear line. They're always blurred a little bit. But there's the referral partner, then there's the ISO. And we break up ISO into 2, retail and wholesale. They're not Visa and MasterCard terms, but they're pretty relevant terms in the industry. And then we have managed PayFac and PayFac. And if I had to put it in a line, I would say referral, retail ISO, managed PayFac, wholesale ISO, full PayFac.
So wholesale ISO would mean that the platform itself is a wholesale ISO.
Correct.
Managed PayFac would be the payment provider is providing managed PayFac services, and then PayFac is full PayFac. The software company is themselves a PayFac.
Yeah.
How does the choice of model impact valuation?
It's a really good question. So the question is, how are you being valued? Is it on revenue? Is it on an EBITDA? Those are 2 big ones. If there's a way to drive revenue that improves the EBITDA, then there's an opportunity to explore and to become a retail ISO or managed PayFac. The referral source is always interesting because, like I said, there's almost no cost to it. It's very low cost. It's very high margin. But you're not in control of the merchant relationship. You're not on the contract, right? So you're not setting the pricing. Now, you might be allowed to set the pricing, but it doesn't mean that the person on the contract, the company on the contract, can't do something to that pricing. That's a big important aspect of it. They also run through a fact of channel conflicts. They might be already processing with that merchant through another vendor, and they have to make a decision. Do I keep it on the software company or do I keep it on that other vendor? Imagine if it's a software company and a large national bank, right? Who's going to have the right to win that one? And the processor's the one making the decision. That's a tough decision. You're not going to have a continuality in salespeople, unless it's successful. They always have turnover. Why not have it be your people that are doing the sales? You're going to control that experience. That's why that's why the retail ISO or managed PayFac, you're controlling that experience. You're controlling the pricing. You also now have 2 levers to price. You can now price on software, which is recurring, and you can price on payments, which is reoccurring. And that's a nice aspect to have. And you can fluctuate between the 2, and you can do incentives between the 2, but you're capturing a larger share of wallet from the customer.
Yeah, so it sounds like the models that give the ISV more control and more ownership of the merchant relationship tend to have, I'll call it, higher potential for enterprise value.
It is because it's about execution, right? And we kind of break it up into kind of emerging, and that's the ones that are just really touching into payments. They're starting this, they've been educated properly, they're set up, they have the right to win, and they're really starting this journey. Then you have the ones that are really kind of in the middle of it, and they're operational. So we know our path, we know our strategy, we know how we're going to optimize this. And then you have the mature ones. And the mature ones are highly sophisticated, they understand payments, they have dedicated teams, they have very favorable contracts to their benefit. They actually have not only do they have management buy-in and executive buy-in, but now it becomes like, no, what is payments this month? Like they're tracking it at that level versus an initiative or even this kind of we're getting there. They're there now. They're a key part of the industry or a key part of the financial performance.
More mature ones are going to have more value created by payments now, but some of the emerging ones might have a lot of potential for future value.
Right. And in any value, in any transaction, there's kind of the bid-ask spread that we have to worry on. So even if payments aren't fully optimized, but there's a path there, that helps with that bid-ask spread.
That makes a lot of sense, especially if the right to win is there and they have the other pieces in place.
Right. And like I said, sometimes it's people, sometimes it's process, sometimes it's technology. It can be all 3, and sometimes it's one or the other. And I've worked with companies on all 3 different levels, and the conversations are different. But for our standpoint, the most I can learn about them and the most I know about the industry, that's going to help kind of find the right path.
Yeah. You mentioned financials as like the next thing that you look into. So I'm assuming this is where payments margin would come in.
Hmm.
Sort of how many bips are they earning on every dollar processed? What else do you look at in financials?
I look my a preference merchant level detail. Everyone, I think that's the difference in our valuation models. Is most do a top down, we do a bottom up. Like I want to look at every single merchant. And it sounds a little onerous, I know, but that's where you find the true issues. So when we do a valuation, we're not just providing a value. What we're doing is we're actually investigating the portfolio, the performance, how's it doing, and then we're giving a really consultative view of the valuation. So it's not just about the number. It's about here are the strengths of your organization and how you're operating. Here are the weaknesses. These are the things you can improve. And when you improve those, you'll get a better valuation, right? But we identify those to our customers. Do this and do this. That's going to improve. Take control of pricing. Make sure you use pricing benchmarks. Make sure you have established rate sheets. Make sure, that the salesperson's incentivized properly to do this, to price to value. It's a lot of things that we bring forward, and that'll let them know if they can, can they achieve that value.
When you're looking at that merchant level detail, what are you looking at?
Volume, number one thing.
Yeah.
Volume over time. Is it growing? Is it declining? Number of transactions, because then you get average ticket,
Yeah.
gross take rate, interchange, assessments, processing fees, take rate. We look at it, if you look at an individual merchant level, you'll see 10% are losing money every month. You'll be like, why? We always tell you, like, well, you're not really a 501c. It's an accounting joke, but you're not a nonprofit. You don't process payments for free, and definitely not at a loss. It's not a loss. It's a utility. Remember, we always make a profit. So, but then we see ones that are above, but we see ones that are growing, and we see ones that might be priced. Sometimes there's ones that have grown and the price too high, and we're like, oh, you be careful. You might want to do something. Software is different than like an ISO. An ISO tried to drive value in order to perpetuate a sale at some point, and they had a really different mentality. A lot of integrated software is they want this revenue to go on in perpetuity, right? They don't sell their portfolios. An ISO would sell a portfolio. I haven't really seen a software company sell a portfolio. So this is a long-term relationship. This is one they're going to keep on as long as the company is operating. And that's different from the ISO model. So I think they just need to be aware of kind of where it fits, what do they need to do, and look at each customer as its own. Our saying here is you price merchants individually, but you manage the portfolio on an aggregate.
Yeah. So I think that's a really good segue into like attach rates and retention. How do you think about those?
We've done studies on this. We've done surveys on this. I've worked with, probably 50 to 100 ISVs at some, software companies at some point, and have really evaluated how that's really progressed over the years and what the expectations are. If they have an existing portfolio, if you're not at 50%, there's a lot of questions that come up. I use the 50%. I mean, if you're 30, you should probably be doing a lot better at 30. 50, we're going to find out, okay. But your new attachment rate should be, 80, 90%. It's especially if your card not present. If your card present, I get it. It's a little more, there's a little more work to do. You got to get a terminal and get that integrated. But you're really pushing towards, I always kind of say, if you're 80%, you're pretty close to, that's kind of a standard benchmark across any industry. But that's only because there's always folks that just won't. And it's like you can spend, it's funny, it's still the 80-20 rule, right? I can spend X amount of effort for the 80, and I can expect 3X to get the next 20. It's like, at what point do you decide, okay, this is good, right? And then we just look at net take rates. We have industry benchmarks for every industry, and we can see those. And then we compare what we see to those benchmarks, and we give our clients advice as to how we think they're performing from a pricing standpoint. We always ask why. We always try to dive in deeper to find out why, they might be, below market or even above market, and we try to understand the value proposition. And I think in those cases, each one's different, but it's good at least to have a benchmark, and we have our proprietary data set to do that.
Yeah. So I'm wondering, do you think about attach rates in a similar way to when you look at the merchant level reporting and financials? And what I mean is, like, if attach rates are high, then that's probably going to drive a stronger valuation. If
Mm-hmm.
attach rates are low, but there are like concrete recommendations that could drive a higher attach rate, then it's like, these are the recommendations. And if you can execute, it can drive a valuation.
And I think that's where a lot of our clients that are private equity firms, when they've looked at software, that's what they've asked us. They've asked us, where can we take this? And that's where our experience and expertise and exposure and data sets, and that's where how we're able to tell them that this is the story. And this is the story they need to continue on, and journey they need to continue on, and that's where they're going to drive value.
Yeah, so it's not just, what's been achieved now, but what else is possible with optimization and strong execution.
Yeah. And if the investors, they want a return on their capital. So they're going to pay X today and they want Y tomorrow, and show me a path to Y.
Absolutely. And then I think the last thing that you mentioned in your framework is leadership. You like to talk to the payments leader. So what are you looking for when you talk to the payments leader?
It's like understanding what they know about payments, understanding where they know about what the opportunities are, how they're structured, who their partners are, how comfortable they are with their partners. A really dynamic leader is tied into the whole company. And they've really made that impression, and they've driven. And that comes from having executive or even board level buy-in. That's going to be really important. You can't do this on your own because you're cross-functional. But when you've sat on diligence calls and you find someone that has worked 20 years in the payment industry, and they worked at these 3 different places, and this is the partner, and this is how they're driving revenue and doing pricing, and this is how they're working on attachment, and this is how they're managing the expense side of it, and this is who's doing customer support, and this is the tiers of customer support, and this is what we can take, and we don't do risk, or we do with risk, and this is how we manage it. Those are companies that come to us and they ask really nuanced questions. But when you have ones that are like, well, this wasn't my first thing, I'm really doing this product role or this role, and this was given to me, and you can imagine those are 2 completely different conversations. But it doesn't mean that person that doing it on the side of desk hasn't evolved. And we've worked with folks that have evolved from, let's say, a finance role or a product role, and now are well versed in payments. It takes a little bit of time, but in a couple years doing this day to day, like I said, we're here to teach, so we tend to work with them a lot when they have questions. But yeah, that's why the person is experienced, isn't experienced, are they willing to learn? How much do they want to make this a part of their career? And when they do, I think that's where you see a lot of them really shine, is, having that attitude of like, hey, I want to learn more. I want to learn this. This is interesting. I mean, that's how I got into payments, almost 20 years ago now, directly, was just because I was like, man, I liked working on that IPO when I was 23 or 24, and getting back into it, it was like, this is a lot of fun. I just got to keep learning.
Yeah, it's finance, except the money movement is the product.
Mm-hmm.
And it sounds like the payments leader correlates to the stages of maturity. A company with a sort of mature, sophisticated payments program is likely to have a payments leader who knows payments really well and has answers to all of those questions. And whereas the company with an emerging payments program might have no payments leader, or a payments leader who's still learning.
Right. So if you're emerging and you're just doing referral and you're fine with that, there's no reason. You're going to have a very probably inexperienced person. They might understand their business, which is great. They might not understand the opportunity. And just kind of progresses along the way. And then of course you have people who work and then they leave, and then you have a kind of a void, and then who's going to pick that up? So you run into those too. So yes, if you're emerging, but you're staying there, you're staying where you're at, you're just going to grow without expending much resources, yeah, you don't need an incredibly experienced leader. But at the same time, if you want to grow, you do. You need to go find those. And we've helped those transitions too, like I said. Even if you have an inexperienced person in payments, we've helped them get to the next level. So when they got to that middle stage, yeah, they're really comfortable with what they're doing. And when they do have those nuanced questions or a change in the industry, they call us.
Yeah. When you think back to a lot of the companies you've worked with and those that received a higher valuation because of payments, like payments actually drove that valuation, what did those companies do right that led to a higher valuation?
Most of them are in that stage of they haven't matured yet, right? They're growing. So they've just shown a path, shown the execution on that strategy, and they're showing year-to-year growth. I think for them, we're at 30% adoption, we're going to get to 80. our pricing's at 40 bips and we're going to get up to 60. Those are the type of things where you've seen the higher valuation because there's a potential. And I think if you look in some investment memorandums, you start seeing those in companies where it's like, there's a $3 billion potential here in payments, and you're kind of going, then why aren't you executing? I shouldn't have to pay for that. I shouldn't have to pay for that. But at the same time, having the story, having some of those wins, showing that path, and you're just executing on time, that's where you're going to show a higher valuation. If you're mature, it's part of EBITDA, it's part of revenue. So, you're getting the max valuation anyways because you're charging for it. I will say that we've seen that software gets valued at a higher multiple than payments. So some companies have kind of, pushed more value to payments. That could actually hurt valuation, right? So it's a really interesting dynamic, but, the recurring revenue from software drives a higher valuation than reoccurring revenue from payments, just because payments isn't contractual. It could stop. They could convert. A stablecoin could take over the world and through a different processor, that's the type of things you have to risk with that.
Yeah, so it's the difference between recurring revenue and reoccurring revenue.
Correct. Mm-hmm.
Yeah. And then kind of holistically, based on all your experience, what advice would you give to software companies? Like, what are the things they need to get right? And what are the critical mistakes they should avoid?
I know this sounds self-serving, but talk to an advisor. And it doesn't have to be TSG. I'd love it to be TSG. But no, we've worked with board members that have been payment professionals. There's a lot of payment professionals out there today, executive level, that we see on boards. And a lot of times they refer business to us as well because, like I said, they're at the board level. They can't do the execution part. There's just a lot of folks out there in that space. And it's different than it was 5 years ago or 7 years ago. 7 years ago, I got my first software client. And now probably half of my clients are software clients. So it makes it really interesting, but it's always where they're at in their stage, the board member, the executive team, friends. Those are the type of things you really need to get a third party because, and this is kind of what I think we've done not a great service on is. Remember, we came from the ISO world. Remember, it was the bank, which was very clean, this is the way. You got to the ISO world. And now we're migrating from that ISO world to the software world or ISV world. And you sell differently. Their intentions are different. What they're driving towards is different. It's not about serving the banking clients with other products. It's not about driving revenue so you can eventually exit. This is about long-term growth, sustainability, revenue, EBITDA, earnings, cash flow, retention, share wallet. Once I can do payments, can I do other stuff? Can I do embedded finance? Can I do payroll? Can I do some other product because I have this? So that's why talking to someone is going to be important. Getting good advice. The number one thing that we've seen that's hurt folks is bad experiences with payment companies. If you're a software company and you've been told or advised or pushed towards this alternative revenue stream, and maybe it was a terrible contract, maybe there were high minimums, maybe you didn't have the volume to do this, and you should have stayed as one entity and you migrated to a different because someone told you needed to be a full pay fac and you do 50 million in volume. You might even have something where you had a great relationship with the person and that person left. That's always difficult. So if we can minimize these poor experiences, I think that's really what's going to, that's going to drive this. So get somebody you can really trust to advise you on what potential next steps are, define where you fit in the market, like your right to win, right? Work on a strategy, find a partner, find a leader if you think it warrants it, or find someone experienced to take on this initiative or interested in taking on this initiative. And then lastly, find that partner that's going to help you get to your goals. And your goals today are going to be different than tomorrow, so can they evolve along the way? And then just good management buy-in, executive management buy-in, because it's going to take resources from other places to do this.
Peter, this was an awesome conversation. Thank you so much for joining me.
No, I appreciate it, Brooke. Like I said, it's great to get the opportunity to talk about this space. It's definitely evolved over the last 8 years since I've been at TSG, and it's going to continue. So we're really excited about it. We're really, this is where I live every day. And like I said, it's more than happy to help folks out as they're kind of choosing which journey to go down.